Testing, testing. Testing, testing.
All right, ladies and gentlemen, we got the CPI tomorrow morning. The market's pricing in a 1% move. Traders are already saying tomorrow's data will be the most important data of the year. And the last time we had a CPI, it was the biggest downside reaction since September of 2022. So, thought that would be a good place to start this video. Here is February 13th, the last CPI zoomed in, and that data came in a little bit hotter, and you see the reaction. If you pull it up on the daily, we were able to gap up and go from there because we had one more CPI ahead of Powell, and now that is the story for tomorrow. So Chad, I got the plays for you. I have the CPI breakdown. All I need from you, a thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. Tomorrow for the CPI, we will be live 1 hour earlier, and we will be getting all of the news and analysis live right when it comes out. So hopefully we see you there, but run it, baby.
Working to the couch, it's a 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel it's a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it.
But right off the bat, as far as the data, tomorrow we're expecting a headline inflation of 3.1, and core is expected to come in at 3.7. So said simply, we are expecting core to come down, and headline is expected to be sticky. Why this is so important, if you remember this chart, this is looking at the headline rate. We have been staying sticky around 3%, and it hasn't been able to go lower. This has been one of those lurking bullish factors. If we get a headline print showing a two-handle, people would love that, but over the last few months, we have been holding this number, and once again, this is expected to happen again. Headline is expected to stay the same. Now, this is where things get interesting, because last time, core didn't move too much, or core came in a little hotter. It was expected to be 3.7. It came in at 3.9. Well, this time, we are expecting core to come in at 3.7 and drop from 3.9. So that's what we were looking for last month. It didn't happen, and that's what really disappointed people. We'll see if that plays out again. And once again, if we don't get below 4 or show that we're really dropping below that stickiness at these levels, it does hold a lot of importance for the data. So keep that in mind. That is the first major thing you got to understand, is that we're looking for a lower core. Headline's supposed to be sticky. Anything that goes outside of that realm, that's probably what's going to move things. But now, this is where tomorrow gets a little trickier, and this is going to be your trick to look out for tomorrow. And what I'm talking about is the 6-month annualized. You may hear this word thrown around, and this is where tomorrow's month-over-month read is going to be a little bit difficult. So if you go to the calendar, sometimes we get weird moves. The month-over-month will come in higher or lower, and then the year-over-year will stay the same. Well, here's the thing. That core inflation rate, I do believe that if it comes in at 0.4, same thing with the headline, that might change some things around, and people are going to start looking at the 6-month annualized. So take a look here. 1, 2, 3, 4, 5, 6. We get another number, and it doesn't go lower, and it actually goes higher month over month. And then even if you go back to the headline, 1, 2, 3, 4, 5, 6, you start to annualize and get a 6-month average. That number may tick up. So if there's a month over month, I believe above 0.41, we may see the 6-month annualized inflation start to go higher. And if you don't remember, last CPI, those numbers came out hot and people did not like it. Yes, a couple days later, we were able to recoup. We are even going to be getting a lot of other data throughout the rest of the week, so that will factor into it. But generally, another hot print, and then if we get 6-month annualized on the rise again, and no matter any way people cut it, if it starts to look less Goldilocks, then we'll have a problem. But generally, anything that comes in status quo, slightly lower. We don't have any issues on the month over month. 6-month annualized still shows a lower number. It doesn't increase up. Then it is going to be a punt until the next data and everybody getting ready and finalizing their bets until Powell and the SCP in the following week. So that's your first key. Very simple breakdown. Like I said in the beginning, a lot of people are hyping this up, and the big reason why people are hyping this up is because last CPI was the January one, had a little bit of the January effect in the revisions. People are expecting a more clear-cut review, and simply this is the final CPI ahead of Powell, so it may have the ability to dictate more movements and be a little bit more lasting, because only thing that could move it now will be Powell next week. So watch out for that. That is key number one. Key number two now, and this is related to tomorrow, the market is pricing in about 1%. So I went over this on stream. We've been spending the last couple of months going over options and pricing, and well, that ghetto standard deviation, you can use that on the S&P 500. Now, in this case, I didn't make a play with it, and all I did was use the daily options to price in the break even for tomorrow and see what the option chain and the market maker is pricing in. So if you go to the at the money strike prices, you could even use like the 490. I think it was like 470 when we did it right before close. It was about 0.009%, about 1% priced in for the break evens on an at the money play for tomorrow. And what that means is that the market is expecting a 1% move after the data. So if the data comes in, nothing surprising, all the numbers come in line. If we move up or down 1%, that should not be a shocker to you. And surprisingly, that's actually a very big amount. Last meeting, we moved big. We moved 1.5 on the S&P. It was only pricing in 0.5, but we only moved big because it was a hotter than expected reaction. But last year, we had way hotter expectations for CPI. We used to come into these events pricing in 1.5%, 2% sometimes, and lately, we really haven't seen those moves. So 1% is kind of generous for tomorrow. We'll see how that plays out, but it's kind of letting you know there's a little bit of hype expected for tomorrow, and depending on what we can get, we will probably be getting some sort of baby shift leading into all of the data and then ultimately Powell next week. So keep that in mind. That is key number two. And then finally, although the CPI is a big deal, the PPI and retail sales, they also hold their own weight. So the way I'm looking at it, I think this whole week with all of the data, CPI, PPI, retail sales, this is going to build the final narrative ahead of the SCP next week and even the Bank of Japan. That's one thing that's been moving the dollar recently. You may have been hearing about the yen. Well, that's going to happen right ahead of the Fed. So this data this week, we will get a little bit more overseas. This should set the final runway, and we see how markets are feeling, rate cut odds, all that good stuff. And then we go from there and let Powell do the dirty work to confirm the trend for the next quarter. But now, let us get into the plays. So, Chattadonia, I hope you're ready for it. That's everything for this week. I think it's pretty simple, even though everybody is getting hyped up. I do think our work is cut out for us tomorrow, so I'm going to start with a weird set of plays, I guess, because they're not really related to the data that we're getting, but I got to start with play number one, Meta. I have Snap up here, but Meta, that's probably the main one. I was looking at the plays today. They kind of had a little bit of a bounce, but I would watch out for it. They had a big drop today, and if you looked at the news, it seemed like the only comments or news was comments from Trump about being against Meta or the TikTok ban and all that stuff. So the way I'm looking at it, it was an overreaction. I don't know why it would have dropped 5%. They were just hitting 520. I think if we get a good CPI tomorrow, things are looking good in tech and people want to buy these names and we don't get too broadened out of a rotation, these may be good to flip on a bounce play for Meta. So going to watch out for that. Even keep an eye on Snapchat. I do think they got a little bit of that today too. So watch out for that. That is play number one. Then play number two. This one, I guess this is one of the plays here for tomorrow, the Zaza/ZQ. And this one's very simple. I brought this up not too long ago. Even Danny brought this up in the chat. A couple of chads were bringing this up. And right now, the odds of more rate cuts is about 20%. The odds of no cuts at these meetings is about 80%. So right now, there is still a little bit risk here. And the way I'm looking at it is if tomorrow's data, if this skews the rate cut odds to like a 90%, a 99% in one direction, I am just going to take the opposite end. So So not guaranteed on this play for tomorrow. It really depends. We need that data to really move something. So if we do get a surprise number, a blowout, maybe this has that effect. But this is something I've been watching for because it has stayed kind of sticky after giving back over the last couple of weeks. So watch out for that. That is play number 2. And then finally, play number 3. I made a baby option trade on this one. This one, it went up right away, and I think it's going to be an interesting one. So we'll see how it plays out in terms of value and CPI and everything else tomorrow. But AAP, Advanced Auto Parts, they got a stake from Third Point, said they're looking to turn around the company a little bit. They have moved a lot already, and that's why I'm saying this could be good, either short-term momentum or a longer swing. But the way they've already bounced, they've kind of had some of that recovery bounce. So I wonder how this activist involved is gonna play out. See if it turns into a Disney situation or anything, maybe a lot quieter. But at the very least, we may get activity. And if the market starts moving in its own little pockets, this thing has its own little bit of news. Would love to see how that trades this week with all the data. So watch out for that. That is play number 3. And as far as everything else, I did make a couple of plays today. I sold out of that one Pfizer for 1,000%. We bought these at 8 cents. I made one free at like 30. Then this one went up to 80, 1,000%. So got out of that. I grabbed 2 Advanced Auto Parts. That was for the last play. Grabbed $90 calls at 5 cents. This was just related when the news came out. I put one for sale for 30 to try to make it free. I don't know if it ended up filling there, but that was just the snake on the chain. Then I grabbed an ADM play for tomorrow. We played both ways on that. MTN, we only played one way. That one's going to get clapped. And then Casey, we played both ways. These ones went up like 200% before the pre-earnings. I think we just got them very cheap for a very expensive call. But other than that, I made a play on MO. I grabbed 44.5 calls for March 28th for 5 cents. And then I made a play on Apple, a 185 call for 27 cents. For next week, they had AI news. But MO, we talked about this one yesterday. They kept going up, and I'm really liking this one. So I decided to go with the play. They don't really move until they actually start moving. So we need one of those monster break live. Wait for it. Wait for it. Oh, there it is. Good morning, ladies and gentlemen. I hope you're having a wonderful day. If you're watching this and it does not say live at the bottom of the screen, unfortunately, you're watching the recap. The good news is we are live Monday through Friday, 30 minutes before open. Drop your thumbs up on the video. Make sure you're subscribed. You're on mobile. Press high chat. X out the chat. Hit the thumbs up button. Second link for the nightly watch list and main channel. First link for the Scream Alerts boot camp and real estate course. But, ladies and gentlemen, in about 9 minutes, you will be getting the CPI. Now, a lot of people are already saying this is the most important of the year. And like we brought up yesterday, the market makers are pricing in 0.9%. Believe it or not, this is the most we have priced in on a CPI since April of 2023. So it was almost 1 year ago today that we expecting a CPI to move us like this. So there's a lot of expectations. We talked about it yesterday on the watch list. Again, that average annualized. So pretty much the main story of what's going to happen today, it's going to happen on the month over month. If that month over month comes in hotter than 0.3, it's probably going to be negative. We will have a problem. If it comes in any lower, that will be good. Why? Because if month over month comes in a little higher, that annualized will end up being very good. And then another thing today is going to have to do with rents. That one went up a lot last time. People are expecting for that one to come down. And then finally, and we're going to go over a little bit more of this, but I'll just tell you right now, after the last print, I brought this up right when we started the watch list yesterday. Last CPI, we dropped the most since September of 2022. We were down by 1.5% on the last CPI. So coming into this one, relief is kind of priced in because everybody is a little bit cautious. Essentially, since a month ago, last CPI, everybody thought it would be a little bit hotter. So in a weird way, everybody does have their guard up. So in it, as weird as it may sound, it may be a little bit easier to get a bullish reaction today as long as that month over month does not come in hotter, all right? So, Chad, are we on the same page? Are we feeling good? That's just a little recap. I hope you guys are feeling good, though. Good morning, baby. I'm going to get you with the good mornings in a little bit. We're here bright and early, man. It was kind of rough waking up this morning. You know that? That daylight savings, bro. It's mad early. So, Chattadonia, get locked in. Like that video if you are early bird, baby. Say what's up, bud. Let's see what we got. I got a couple of updates. So, economists are expecting a 0.4 month-on-month rise, the most in 5 months. 0.3 for core, which excludes food and energy. 3.1 on year-over-year, same as January, and 3.7 gain in CPI, the smallest since April of 2021. The consensus is pretty big, around a 0.3 forecast for the core monthly CPI gain. Some 51 out of 63 economists surveyed have that penciled in. There are just 4 predicting 0.2, and 8 are predicting 0.4, so it'll be a big surprise if we indeed don't come in at 0.3. Bloomberg is expecting headline to go to 0.4 and core at 0.3. They think headline will stay at 3.2. A 3.5 seasonally adjusted increase in gas prices should drive the brisk headline inflation. Core goods will continue to be the primary driver of disinflation, led by car prices, and then primary rents and OER should both rise at 0.4 month over month. Anna Wong and Stuart Paul, Bloomberg Economics, say they expect headline for February to accelerate while core CPI should slow slightly from January's hot pace. The first month of the year typically sees higher inflation because of seasonal effects that aren't fully adjusted for, so risk of the core reading are tilted to the high side. More importantly, the report should confirm whether the unusual spike of owner's equivalent in January was an aberration or a signal of stickier housing inflation. Ultimately, we don't expect CPI report to provide clear evidence of disinflation to boost the Fed's confidence. However, they could have that confidence by May. Our base case is the first cut as both inflation and the labor market cool further. There's a lot of focus on February's inflation data, given the upside surprise of January numbers. Was January a blip or a warning of what's to come? Is there another surprise that would suggest that inflation is more entrenched than it would be expected if it was a narrower scope for the Fed to bring rates down? If the data comes in or around consensus, then it will be a green light bets on a Fed rate cut. As Edna points out, CPI came in hot for January. That was also true of PPI as well as PCE, which is the one that the Fed uses. A big question was whether that was all a bit anomalous, influenced by one-off increases to the start of the year. For what it's worth, the jobs report for January was also hot, but what we got in February release on Friday came in all but softer. Let's see what extent, if at all, if that's repeated with the February CPI. Inflation has been surprising to the upside since early February, pressing an index back to the positive range. A brief run below zero is associated with a dovish shift in Fed. Recent surprises have had a hawkish effect instead. There's been a lot of confusion about the months since the last inflation numbers released by the Bureau of Labor Statistics tied themselves up in knots when it told us of rental inflation was partly responsible for January's acceleration in CPI. Most attention today will be on shelter costs, which was the single largest contributor for January inflation, and then on services such as medical care and transportation. Fed officials sometime have highlighted the so-called supercore of inflation, which strips out not just food and energy, but goods. Has seen disinflation thanks to supply chains normalizing in housing. Supercore service prices are thought to be tied closely to labor costs and have been pushed up by the tight labor market over the past couple years. Unfortunately for the Fed, this measure jumped in January. Let's see. Ira Jersey and Will Hoffman will be looking for any downshift in lower volatility sectors of core CPI, which have been propping up inflation. Lower volatility sectors tend to be stickier and trend for longer. The downtrend in those sectors resumes. That adds odds of a May or June Fed cut could increase. Live, baby. We are live, yes. We got about 3 minutes until the data. Again, month over month, that's going to be the big one. What happens with real estate prices, and then again, just month over month and how that factors into the 6-month annualized rate. That is what we will be looking out for. And again, you could go to bls.gov and then go up to economic releases, and then it should be under inflation and prices, and then CPI. This is where I'm going to be reading from right when it comes out. Early birds, baby. Like the video. Amen. All right. I should be getting final comments in here. And then we're going to be good to go. Again, a lot of people after the last meeting, they are expecting this one to be a little bit negative. So in a weird way, people are kind of on defense. Even though the S&P's at like 5,100, people do feel a little defensive. But then again, too, any big surprises here is going to confirm things for Powell, a.k.a. a big miss or a big beat. Should be very exciting, ladies and gentlemen. So today will be one of the most significant inputs for the Fed makers before they assemble their new projections for the economy. Back in December, the median estimate was 3 rate cuts in 24. Tuesday's release could potentially shift that after today. Thursday's producer prices and retail sales and Friday's surveys could argue the remaining notable inputs. There's a risk of reading too much into today's data, says economist at Citi, noting a lot is riding on February CPI, maybe too much. Market expectations seem to be leading towards another strong increase in core CPI, but we would caution that recent volatility in data implies greater than usual uncertainty and suggests not reading too much into any 1 month of data. Even a softer increase, while likely very encouraging, who seem on cutting rates by mid-year, would not necessarily change our view on the remaining underlying inflationary pressures. All right, Chattadonia. 1 minute. 1 minute. So like that video. Get locked in, loaded. Let's see what happens. I will have the BLS website. We'll go to that in a little bit. So again, 3.8 is for the core, 3.7 on the core, and then 3.1 on the headline. Anything higher, not good. I would watch the core. That's what people are going to trip on. And then month over month, again, anything hotter than 0.3 might get people a little bit jumpy. So let's see what happens. 10 seconds. Good luck, Chattadonia. Good luck. Let me get up the dollar. Let's see the dollar. All right. Oh, came in at 0.4. So core came in at 0.4 versus 0.3. I think headline came in at 0.32. Yeah, month over month, and core and headline both came in at 0.4, 3.2 year over year. And then where's the core rate? I think core is up by 0.12. Yeah, core. Yeah, 3.2. So core came in a little bit higher there, and so did headline. I don't think that's good. Let me read the thing. But so far, I mean, the reaction is kind of small. Remember, this is the biggest we were pricing in. It came in line, but a little bit to the hotter side, which, again, I do believe that happened last time, March 12th. I already got the report. So let's see. CPI for all indexes increased by 0.4 in February. Seasonally just basis after 0.3 in January. Index for shelter rose, as did the index for gasoline. Combined, these two indexes contributed over 60% of the monthly increase for all items. The energy index rose by 2.3, as well as the components of all other of its components rose. Food index was unchanged in February, as the food at home, food away from home rose by 0.1. Index for all items less food and energy rose by 0.4, as it did in January. Indexes which increased in February included shelter, airlines, motor vehicle insurance, apparel, and recreation. Index for personal care and index for household furnishing and operations were those that decreased. The all item index for 12-month, a larger increase than the 3.1 over the 12 months ending in January. All items less food and energy rose 3.8 over the last 12 months. Damn. So the 12-month average now for headline is 3.2, which is good. But at the same time, again, all those 6-month, 12-month annuals average, even the 3-month, they have remained very sticky. So again, slightly hot is the reading on this one. Let's see. So food was unchanged in February. Food at home, both of these index rose by 0.4. 3 of the 6 major food grocery store groups decreased over the month. The index for dairy and related products decreased by 0.6, led by a 1.1 decline in those related to cheese and related products. Fruit and vegetables decreased by 0.2, as did non-alcoholic beverages. Cereals rose in bakery by 0.5, following 0.2 decrease in January. Meats, poultry, fish, and eggs rose by 0.1. Food away from home rose by 0.1 after rising 0.5 in January. Index for full-service meals rose by 0.1. Food away from home, 0.1. Food at home rose by 1% over the last 12 months. Index for other food at home rose by 2.3 over 12 months ending in February, as did index for non-alcoholic beverages. The cereals and bakery products increased 1% over that period. The index of fruits and vegetables rose by 0.8. In comparison, dairy and related products fell 1.8 over the year. So bonds are still down. I want to make a bond play like last time, but they haven't even moved too much. So, again, we're slightly up, but I think today's going to be a little bit more bouncy all over the place. Yeah, again, it's a slightly hot read, but remember, like we told you, everybody was preparing for a little bit hotter because of last time. So, essentially, the last two CPIs have both came in slightly hotter. You do have the chips all moving around right now, so we'll see where that takes us. But, again, food at home rose by 1%. The food away from house rose 4.5 over the year. Index for limited service meals rose 5.2 over the last 12 months. Energy rose by 2.3 after declining 0.9 in January. Gasoline increased by 3.8 in February. Before seasonal adjustment, it was 4.3. The index for natural gas rose 2.3, and electricity rose by 0.3. Despite the monthly increase, the energy index fell 1.9 over the last 12 months. Gasoline increased 3.9. Natural gas declined 8.8. All items less food and energy rose by 0.4, as did the previous month. Shelter rose in by 0.4 in February. Damn, so shelter went up a ton again. Was the largest factor in the monthly increase versus all items. Index for rent rose by 0.5 over the month, while index for owners equivalent by 0.4. Lodging away from home increased by 0.1 after rising 1.8 in January. Airline fares rose 3.6 in February, following a 1.4 increase in January. Index for motor vehicle insurance increased by 0.9 month over month. Among the indexes in February, apparel, recreation, and used cars and trucks. Medical care was unchanged after rising 0.5. Index for personal care fell by 0.5. Index for all items less food and energy rose 3.8 over the last 12 months. Shelter increased 5.7 over the last year, accounting for roughly 2/3 of the 12-month increase of all items. So literally, shelter was very hot again, both owners equivalent and just rental prices. Non-seasonally adjusted. Let me get you some updates. So before this relief, Stephen Stanley at Santander has indicated a 0.4 would force a substantial tone shift at next week's meeting. Food was unchanged. Bond yields moved up. Shelter and gasoline were behind the cost increase, accounting for 60% of the monthly increase on the index. This isn't good news for the Fed. The second straight 0.4 reading suggests that January wasn't a one-off monthly. Probably notable that core beats estimates for both monthly and annual readings. So again, still slightly hawkish read so far. People are optimistic. This market's holding up here. Couple names are going crazy, but again, these calls for a little bit more of a hawkish read are continuing. And then that's non-seasonally adjusted. I think that's it. I mean, we could go index by index. SPY breaking out now. So again, we're up by 0.5. We have 0.1 in the system, but honestly, I think today's going to be a little bit volatile. But for now, you are going up there again. Slightly hottish read, but you are moving up. And again, literally, I think housing and gasoline were the biggest increases. Food didn't move as much. Healthcare and insurance, they didn't really get in our way. The BLS says core measure was boosted by items including shelter, airfare, motor vehicle, apparel, and recreation. Is this good or bad? I would say this is bad a little bit, just because now 2.4s kind of show us that we have inflation ticking up. But I do think the market was kind of preparing for a hot print. But in general, I do think this does make Powell a little bit harder to read. So I'm leaning towards slightly. I think this is both, I think, neutral, but I'd lean more to the hawkish side. However, first reaction is literally straight up. Bonds are down, dollar went up, and then again, NVIDIA, Meta, and a couple of other names are already running. Only thing you can say is no landing. Yeah, I mean, because again, until inflation starts ticking up, at the very least, this is just showing inflation at lower levels. Maybe it comes back up, but this is all in this environment, which has not been too bad. Dollar back to red. I don't think my UUP's loading up. Bonds are trying to catch a bid. Again, some tech stocks are already moving. Gold already bounced a decent amount too. We'll take it. Teaching my 12-year-old son, 13 Fridays, CPI, his first time watching. Oh, man. Well, welcome. Welcome, young DA. Get that long term. This is big. I mean, the irony, I don't know if you want a fun fact being, like, young, is that, like, a couple years ago, we never cared about CPI. That's, like, the crazy part about the market is that every couple of years, you know, depending on what's going on, the market gets really caught up on a data point. You know, we didn't really experience inflation until recently, and literally, like, you know, I remember when I was 13, I was trading for up CPI, so it's a very, very cool experience you're getting now to be familiar with it. So very, very wild. Good morning, my friend. So again, BLS says super core was pushed upwards by expenses in real estate, travel. Yeah, Treasuries pair post CPI drop, revert to little change. So again, SPY is like barely moving. That's the crazy part, is that you're up less than a quarter. Remember, we were pricing in 1%. This was the biggest pricing in since April 2023 CPI. But I mean, we're barely up here. Again, it's a slightly hot read. Again, I wasn't the only one. People were kind of a little nervous by that 0.4 measure. But so far, the market's kind of taking it in stride. But like I'm saying, I think hawkish neutral or bearish neutral would be my stance on the day. But then again, we're going to have a long 7 hours. So average monthly gain for Supercore was about 0.2 over the 3 years before the pandemic. So we're running more than double that at February. The so-called Supercore, core services excluding shelter, rose by 0.47 month on month. That's down from a super hot 0.85 in January, but still too fast of a pace for Fed policymakers. You think we'll ever go to not caring about it? CPI, yeah. In a couple of years, CPI is going to come out and you're not going to react. Once we get over this inflation story, once everybody gets over the politics and the Powell and all of that, eventually we'll fall back into a time where nobody really cares about CPI. As Chris says, this isn't good news for the Fed. It's hardly good news for the Biden administration. This year was meant to be one of disinflation, but today's data really leans into the idea that the last mile is the hardest. Biden may take some solace from the fact that the food index was unchanged given his administration has been going hard on the theme of shrinkflation. Still, overall inflation is looking stubborn. CPI is Consumer Price Index. They just take a basket of goods and measure the price changes every month, right? Right. You go, if you bought the same items every month, how would the price changes increase? And they use that to get an idea of how consumer price inflation is affecting people. Well, you're going higher. You're hitting another high again. You're up by 0.6. I don't think that's 0.6 from the move. Open. News on 3M. They were running pre-market there. But not bad. It hasn't even been 15 minutes, so wait for the first 15 minutes, see where the market goes from there. I think that will be an interesting shift, to say the least. This move doesn't make sense. It doesn't, kind of, for now. I mean, I'm glad that it's small, but, I mean, this very well could, like, pick up fast is what I'm aware of. But for now, I mean, this does... I want to see the Fed futures. This makes Friday, or this makes next week a little bit more shaky. I mean, that's all. Just we've had 2 months in a row now of inflation, like, legitimately hotter than people are expecting. There hasn't been anything very negative that people have been expecting. It's not like the hotter inflation has led to a massive decline or a massive wave, but this is the second time in a row where you are getting a very hot print versus what people were expecting. And, I mean, I don't know. I think there's an elephant in the room, is that real estate is reigniting. I don't think everybody's been talking about real estate coming down, but and then the actual core inflation, real estate, 12-month annualized 5.7. So I do think that's kind of the problem, but we're taking it good. I don't think we're like going too nuts here, but surprisingly, I mean, 2 back-to-back hot inflation unbelievably well. Maybe this is why people were saying the other day that if we don't even cut rates, maybe the market will still hold up, because even in this environment, your CPI isn't really affecting it. So give it 2 minutes here. It'll be the first 15 minutes. Get ready for a little shift, and then we'll go from there. Interesting to see a disconnect between price trends for new and used cars. Prices for used cars and trucks rose by 0.5 in February from a month earlier after falling 3.4 in January. Meanwhile, new cars fell by 0.1. The market rallying on the back of higher than expected headline and core. A little surprising to Bloomberg rate strategist Ira. The rates market looks to have been set up for an even worse inflation print, but we do think this print warrants we don't think this print warrants a sustained rally from these levels. So, yeah, Ira's thinking bearish as well, too. He's a little shocked by the first reaction. So, usually it takes like 30 minutes to start bouncing, but we bounced within the first 15. So, let's see what happens here. But, again, surprisingly a little bit higher. All right, 44, 45. Yeah, disconnect. Prices, again. Less analyst comments. Again, a lot of people, most of the comments prior, is like that one dude who was saying, anything at 0.4, people were going to get worried. So, again, even bonds are coming up. If the bonds catch a bid, that gets even crazier. So if we rally, stocks go up even towards the 1%, and then the bonds rally, that'll just be mind-blowing. We'll see where the dollar goes, too. The JPM say short the bonds still? I'm not sure. The only thing, JP Morgan, Diamond, he came out today, said something about a recession still right around the corner. But I don't remember what they have said about bonds. Yeah, same. Well, last month was a lot hotter than this month. So maybe that's the silver lining. So January's numbers were really, really hot. They surprised. Again, Supercore went up by like 0.8, 0.9. Last month was really hot. This one was hot like last month, but it wasn't as hot as last month, if that makes any sense. So it is better. It's an improvement from January,
testing.
but still an overall deterioration from like October, November. And then again, 12-month annualized inflation is high. 12-month annualized inflation, 6-month, 3-month annualized inflation, they're all going up now. So if you looked at a 6-month inflation gauge on core, that has to be climbing now after a print like this.
Testing.
So you're going up higher here. So again, a lot of people were kind of caught there expecting some downside. We'll see though. It's been 15 minutes, but so far I'd say you're up like what, 0.25% off of the hot print. Again, slightly hotter CPI 0.1 month over month. Well, this makes things a little tricky. Core CPI beat expectations, rising 0.4 on the month, well, 0.358. It beat, but it was very close run thing. Shelter prices nudged back down to 0.4, but with overall service prices up 5. What are these guys saying? It looks like core services was, for example, were up by 0.6, and the broader core services, excluding housing, were up 0.47. That should be interpreted completely hawkish, but thus far has not been, which speaks to the asymmetry. Still, when the dust settles, I expect yields to rise some more, if for no other reason than to clear the decks for today's 10-year auction. You have to think the increase of the risk that the Fed policymakers remove one of the three rate cuts that they had projected in December. Next week, Fed policymakers will release their updated forecast. The median dot will be one of the first things, if not the first things people will be looking for. Treasury yields are now a tad lower. If it goes to show markets can move surprising, only 10 of the 70 economists surveyed by Bloomberg had anticipated a 0.4 core gain. Everybody was at 0.3 or lower, but treasuries are slightly up on the day and stock futures are climbing. AKA, none of this was priced in, but we're still going higher. Yeah, you do have a runway till Thursday. There's PPI on Thursday. Today's only Tuesday. Alrighty. First 15 minutes. Not too bad, though. So, again, I still think neutral hawkish, neutral bearish, but you're up for now. We'll give it a second. I'm going to go get ready here for the morning. Let me get your news together. Follow me on Instagram at the Trading Fraternity. And I'll be right back, baby. Good morning. Happy CPI Day.
8%. The euro is stronger. At least the dollar's weaker. Euro dollar right now 109.37.
Which is confounding to me. And it goes to this question. Is it the David Kelly version of things, which is essentially that this is just a bumpy road down to 2%? Or is it a Steve Raschuto form of things where nobody wants to fight the Fed and the Fed wants to cut rates? And frankly, that's what they're going to do. And that's going to support things no matter what. And nothing in these numbers is strong enough to derail that.
David Kelly and Steve Raschuto with us right now. David Kelly, let's talk about the Federal Reserve. Governor Waller, what's the rush? President Kashkari, why do anything? You've got an answer to that. David, what is the answer?
Well, I think the answer is, to be honest, the Federal Reserve should not be trying to micromanage aggregate demand in the economy. If we've got a federal funds rate between 5.25% and 5.5%, that is a tight policy. It is designed to slow the economy down. It can cause, it's given us an inverted yield curve. It's causing problems in the pricing of assets and in regional banks. I don't want the Fed to cut aggressively, but I think they should gradually move back to neutral if the inflation rate is heading towards 2%. And so I think they'd be right to start in June, cut again in September, cut again in December, take it easy, but bring rates back down to a neutral level, which I regard as being somewhere in the 3.5% to 4% range for the federal funds rate. But they ought to do that because there's no reason for them to be interfering with the economy, which is actually going in the right direction with inflation, in fact, heading towards where they wanted to go. And on the issue of auto insurance, I realize that auto insurance prices have gone up. I have to pay higher auto insurance too. My real issue is it's up 20.6% year over year now. And whether the government is measuring that wrong or correctly or incorrectly, I'd be willing to put money on the table that won't be up 20.6% a year from now. In fact, I wouldn't think it'd be up as half as much as that. So if it comes down over the course of this year, it's going to pull the CPI inflation rate down. So I do think that inflation is coming down. And if the economy is moving in the right direction, the Federal Reserve shouldn't have its hand on the tiller either way. That's why they should move back to neutral.
Which raises this question, David. And before we go to Steve, I am curious, though, about the oven and the cookies, just because there is the sense that if you have easier financial conditions, as we see today in the market on the heels of a hotter than expected CPI print, that this will actually keep these multifaceted areas, continue to make them hot. Basically, the wall of money isn't going away because real wages are actually increasing. How do you fight against that idea?
Because we've had, for years, we've had an economy which, before the pandemic, before we had all this fiscal policy, we had an economy which was quite capable of producing low inflation. You know, yes, it's a tight labor market, but I mean, how many major strikes do we have occurring right now in the United States today? I think the answer is zero. I mean, we're not seeing a very vigorous labor force demanding high wage increases or they'll quit. And so I think you can actually run this economy relatively strong at high levels of capacity without generating higher inflation. And what's wrong with that? So I do think this is not an inflationary economy at its core. We got inflation because of the pandemic, the policy response in Ukraine. That's fading and has really faded. And because of that, I think inflation comes back down to 2% anyway.
This is fascinating, Steve, because ultimately this is one of the big disagreements. Are we entering a new normal, or is this going back to the old? I mean, is that essentially the breach between yourself and David Kelly?
Well, there's this concept that because we were there before COVID, we're going to go back to there. Okay. It's a simple argument. The reality of the situation is the world we had before COVID had two very big differences. One, Larry Summers was talking about secular stagnation, okay, which clearly was not correct. Alan Blanchard, on the other hand, I think was 100% correct, talking about the fact that we had a debt overhang. Well, COVID corrected that debt overhang, okay? The federal government bailed out all the state and local governments. The lower interest rates allowed everybody to refund all or refi all of their mortgages and all their corporate debt at much lower levels of interest rates. Interest expenses are actually no problem for corporate America. That's a big difference there as well. The other fundamental difference that's taking place is before COVID, people were uncertain in their jobs. Okay? There was a high degree of uncertainty in employment. People were always convinced this whole concept of double-digit earnings, corporations' earnings, was going to bring down their employment. They could get fired any moment. Now there's a lot more security in your job. And when there's a lot more security in your job, it doesn't mean we're going to get accelerating inflation. The question is, does inflation come back from 3 to 2? There's a big difference between the two of them. And the big difference is not necessarily an equity consideration. It's a bond market consideration. Because fundamentally, where should the 10-year note be? The 10-year note should take the inflation target, or the long-term outlook for inflation, and add the underlying trend rate of growth to the economy. So if you have 2% inflation, you should have a 10-year trading range of 3.75 to 4.25. We're basically in the middle of that range right now. If it's 3% inflation, then it's 4.75 and 5.25. We're nowhere near that range. And this is the fundamental difference. And this is the problem for the Federal Reserve. They have a 2% target. Okay, they don't have a 3% target. They have a 2% target. Now, markets right now are allowing them to continue to be patient. At some point, the markets may say, we're not going to allow you to be patient. And that becomes the concern. When the bond market begins to turn around on them and say, you know what, we're not dealing with this, that you're going to get back to 2% inflation. That's the risk if they move. If they move and you wind up seeing the dollar go down dramatically, you could reverse a lot of the goods inflation, disinflation that has been taking place. And if that happens, they then have an inflation problem on their hands. And this is why they have to be patient, and they're probably going to have to be patient throughout the balance of this year. But it's not a negative equity story, because this Fed does not want to set this economy back. It's a positive equity story, and that's what's happening in equities. My consideration is the yield curve could stay inverted a lot longer. And just because the yield curve's inverted doesn't mean it's a problem for the economy, because nobody borrows at the front end of the curve anymore like they used to. And that's a critical differentiation.
You're asking a balance of risk question around the Federal Reserve, and I think it's an important question. David, help us answer it. The biggest risk right now, is it cutting too soon or holding too long? And why do you still believe it's holding too long?
Well, I don't think the biggest risk to the economy is actually the behavior of the Federal Reserve. I think they should, you know, as a matter of long-term strategic policy, move back to a neutral rate because the economy doesn't need them to be tight. at this point. But the bigger risks to the economy are really from outside of the behavior of the Federal Reserve anyway. Geopolitical risks, environmental risks. If something happens to oil, then our entire view of the world sort of changes a bit here. So I think the Fed ought to begin to cut. I think they will begin to cut. But my main point is that as we look at the data month by month, category by category. Now, we do build up to the pieces of the index because that's how we forecast. We have to look at the individual pieces. And what I see is a global economy, which is relatively sluggish. China is sluggish. Europe is sluggish. It's not generating enough demand to push up core goods or even food and energy in any way. So without some supply shock there, the whole goods part of the global economy is not going to give you inflation. I don't see a labor market that is particularly inflationary either. And so that allows you to come down to 2%.
Let's agree on one thing. We do this again next month. David Kelly, Steve Rasciuto, to the two of you, thank you. Inflation data just a little bit hotter in the equity market. The green light is still on, apparently, to carry on rallying. The S&P 500 positive, 0.4%. Big day to follow up tomorrow. Looking forward to that coverage from New York City. This was Bloomberg Surveillance.
They got rid of him.
Welcome back to another BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel.
All right, Chattadonia. We came down a little bit. You are barely, I guess, a little bit unchanged from the data release. Again, the data came in hot. We had a positive reaction, surprisingly. So we'll see how it plays out. But for the most part, inflation came in hotter. Core and headline month over month. Super core was not a good look either. There was a couple of negative things, but I think we're going to have an interesting day of volatility. Remember, you were pricing in 1%. So, Chattadonia, I hope you're feeling good, baby. I hope you're blessed, but happy Tuesday. Good morning. What's going on? What's up, Carissa? Oh, she said we could hit 1150 before open. I know you could do it. Positive berries, baby. Hit that like button. Say what's up. Good morning, baby. What up, Nelson? Good morning, Tony, Zoraz, Tim, Laurie, Najee, Wolf, Laker, Jay. Good morning, baby. What up, Ken Sam? What up, Days? What it Loser, Jeremy, El Chapato, Matt Bean, Devlin, Daniel Westerain, baby, Monica, Hobby Life, Mark J. Good morning, baby. What up, Bino? What up, Alex Lozano? What up, Troy? What up, Mariano? White Shits, Brian Fierro's, baby, Sankey, Candy, brother, Jay Samuels, baby, Brian. Oh, good morning, baby. How you living? Happy Tuesday. What up, Shamik? Lenny, Sarah, Nelson, Kelvin, Ramiro, the burrito, baby. Good morning, Kenny, Sway, Venus, Doppler, Nathan, Kennedy, Michael, Joshua, Ray G, rest assured, Eduardo. Good morning, baby. What up, OCK? Good morning, Stuart Cameron. What up, Damien? How you living? Michael Pila. What up, TS Trading? Mr. Nice Watch, baby. Gary Avari, Schofield, Jamar, Battleborn, baby. What up? What up, Awaz? What up, Eric? Lucky Soldier, baby. Good morning. Mo, Sam, Burlap, Forbes, Johnny Benz, Farticus, baby. Good morning. Oh, my goodness. What about that Twitch? What about Nikki on Smash? What about Cooler Vortex, Sidonian, Braxton, Mr. Squeeze, Robo Handtech, Uncle Nick, Smealy Dinero, Shiz, Big Carly, Charlie and the Tree, baby, UNAM, Be Me Seymour, Lightning Blue GT, S. Jones Jack, Gaines for Real, Smealy Dinero, Thumb Solo, S. Jones Jacks, Gaines, baby, Steve Lozano, Young Pickle, Young Nick Pie, OVO Juice, Gaines Real, Solomon, Dev Patel, Progressive Trance, and 297, and Ibex, and Solomon, and BDA, and Uncle Nick, and Midwest Finest. Oh my gosh. That's it. We had a lot of time, baby. Again, we've already been here a little bit earlier. A little bit earlier. So, Chattadonia, I hope you guys are ready. I hope you are locked in. It's a pretty simple morning. Again, if anything, I think the data came in. It came in easily hot, right at the numbers, but hot. But now everyone's like, wait a minute. I thought this was bad and we're doing good, but we're not doing too good, but we're not doing too bad. So wait for the bell. But on that note, Chad, I hope you're ready for it. Like that video. Let's get those likes up. Let's have a great day here, bright and early in the morning. But now I'm going to get my news assistant. He's going to give you some news, and then we're going to go from there. All right, and I'll close it out with a couple of other things. Amen? Amen, amen, amen. All right, stock futures. Ba-da-ba-ba-ba-ba.
Stock futures whipsaw after U.S. inflation report. Stock futures whipsawed after inflation data did little to alter bets the Federal Reserve will be in no rush to cut interest rates, with traders still betting on a first move in June. S&P 500 contracts rebounded after sliding in the immediate aftermath of data showing underlying U.S. inflation marginally topped forecasts. Treasury 2-year yields, which are more sensitive to imminent Fed moves, were little changed around 4.5%. The core consumer price index, which excludes food and energy costs, increased 0.4% from January, according to government data out Tuesday. From a year ago, it advanced 3.8%. The so-called supercore measure, core services prices excluding shelter, rose 0.47% on the month. That's down from a superhot 0.85% in January, but still too fast a pace for Fed policymakers. The Fed is widely expected to hold interest rates steady for a fifth straight meeting when policymakers gather March 19th to 20th. Much of the focus by investors will be on the Federal Open Market Committee's quarterly forecasts for rates, including whether fresh employment and inflation figures have prompted any changes. Corporate highlights. Oracle Corp reported a spike in bookings in its cloud computing business, showing progress in its bid to capture more of the competitive market. Kohl's Corp reported same-store sales in the fourth quarter that missed the average analyst estimate, suggesting the department store chain struggled to attract shoppers during the crucial holiday shopping season. 3M co-named aerospace veteran William Brown its new chief executive officer. Ending a turbulent run of nearly 6 years for Mike Roman marked by a declining stock and growing concerns over legal liabilities related to so-called forever chemicals. Deutsche Bank AG chief executive officer Christian Sewing vowed to meet previous cost targets, saying he's working on additional measures. Southwest Airlines co-plans to cut flying capacity for the full year. Halt most hiring and rework schedules after Boeing co-slashed expected 737 MAX deliveries as the plane maker faces regulatory and criminal investigations over safety issues. Archer Daniels Midland Co. revised its intersegment sales for the last 3 years following an internal probe into its financial reporting and disclosed a $137 million impairment charge related to its animal nutrition unit. The shares rose in early trading. Scholastic Corp., the biggest publisher and distributor of children's books, has agreed to acquire 9 Story Media Group, as it looks for ways to broaden the audience for its library of children's stories. Not so fast. Still, Bloomberg Economics says today's print is unlikely to enough to convince Federal Reserve officials it's safe to begin lowering rates. While economists Anna Wong and Stuart Paul say the annual core reading may drop to the lowest since April 2021. That won't provide clear enough evidence of disinflation to boost the Fed's confidence to cut rates. However, they say the Fed may finally ease as soon as May, which is their base case for the first cut, as inflation and the labor market cool. Earnings hopes. Away from inflation, analysts are turning more optimistic on the outlook for 2024. Bank of America strategists say U.S. equities are entering a virtuous cycle after another strong earnings season, prompting them to raise their S&P 500 EPS estimate to levels that imply 12% growth year-on-year. They also see the U.S. economy growing 2.7% in 2024, almost double a previous forecast. The upgrade comes after the strategists said Monday they see little evidence to support the worriers on Wall Street, who say the stock market has risen too far, too fast, and is approaching bubble territory. Dimon pessimism. This kind of optimism hasn't rubbed off on JP Morgan CEO Jamie Dimon,